Before we start, Andy, I just wanted to say a quick thank you to our podcast sponsors, Money Farm. Now, Money Farm are the largest digital wealth manager in Europe, and they create portfolios of ETFs for their clients. They're incredibly cheap and ideal for somebody who's wanting to get into investing, and perhaps for more experienced investors who don't actually want to run their own money anymore. Now, they will even offer to run the first £20,000 of any of our listeners' portfolio absolutely free if they enter the code MTTM20K into the website at moneyfarm.com. For more information, check out their website. But for now, Andy, let's get back on with the show.
Hello and welcome to episode 170 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. You're fighting fit this week, I hope?
I'm fighting fit. I like the way you said, as always. I know you say it at the beginning of every podcast, but technically speaking, I wasn't here last week. So,
No.
So thank you to everybody who got in touch, who were concerned about my absence, and which was quite nice actually. I had emails, tweets, etc. So it was quite nice. It wasn't anything too untoward. I know a lot of people assumed it would be my Crohn's, which I am very open about talking about, but it was a inadvertent, almost partly in relation to that, but a drug I take that keeps my Crohn's under control, suppresses my immune system slightly, and I basically took that drug at the same time I acquired a chest infection, which therefore you can imagine just hit me for six. And it got to the point, despite working in bed and trying to soldier on, I had to give in at the end of the week, and I just couldn't talk. So that was why Andy did a marvellous job of regurgitating something that we did at the start of the year for the investment piece, which was particularly relevant given all that's happened so far. And Andy was very good to almost, and probably quite generous in his statements of me pretty much predicting a market sell-off. I'll take that. But yeah, so thank you to everybody who wrote in. And I mean, you even got a review, didn't you, Andy, off the back of that?
Yeah, there was a really good review, came through on the 12th of March, and it says, "This was the first time I've listened to a Money to the Masses podcast. I found the subject matter really helpful, describing the importance of the VIX in pointing to possible market corrections and also providing context of why bonds and equities have been moving in the same direction." And that was from Steve Hill 59. So yeah, thanks for that. That's always great to hear. Always happy to receive reviews. Thank you.
So the message there is, it was a very good review by me not being there. So we should do it more often. So anyway, I'm back fighting fit, and I even missed Tottenham getting knocked out of the Champions League at Wembley. I didn't even go to the game, so that shows you how ill I must have been, or how rough I must have felt. So everybody out there listening to this podcast can probably sympathise, because at some point they've probably had the same thing that I did. But there you go. Anyway, so we're back on the money stuff this week. Shall I tell you what's on the podcast, Andy?
I'm raring to go and desperate to know. And that rhymes.
It does. You've been practicing. On this week, I'm going to do a bit of a roundup on digital banks, so these app-only banks that exist out there that are gaining increasing popularity, but some recent research started to suggest perhaps a number of, quite a significant portion of the market is starting to get slightly bored with them. But anyway, I'm going to have a run through on those. I'm going to talk about the end of tax year, which is only just round the corner, and there are going to be some changes at the tax year. Some of them are changes to personal allowances. I'm going to do a roundup of that and a little bit of a mini to-do checklist. And finally, I'm going to look at some pension myths that are going to be debunked.
Oh, I love a debunker. What are we going to start with then?
You choose, Andy.
Come on, let's do the changes for the new tax year coming. Let's do the tax and the boring stuff. I'm sure there's some more interesting stuff than tax rates and thresholds, but let's do that.
So the tax year starts on the 6th of April every year, and there are normally one or two changes that happen, whether it's to personal allowances or tax rates or something like that. So I just want to give a quick roundup of those. I am conscious I never asked Andy how he is this week, because I normally do that and we have a chat, but I know how he is, because he's grinning because he's eating malwams as we're doing this podcast, and he's skillfully doing it so we don't notice, and I dare say he'll let it out the chomping, so he's a very happy man actually. And I'm slightly jealous.
Do not let the listeners behind the curtain. You know the rules. It's a wonderful thing, this mute button here.
Yeah. So while Andy eats malwams, I'm just going to throw a few things out there. Now, on the 6th of April this year, there is a possibility that your council tax will go up because the local councils in England have been given the power to raise their council tax rates by 5.99%, so basically 6%.
Mine's already gone up, Damien.
Has it?
Yeah, I got the notification through 2 days ago. It's gone up £10 a month. So we split ours over 12 months, so it's gone up £120 this year. So we're annoyed about that, but it is what it is.
Yeah, and I was just going to add to that, which is just, Andy, is proof of the increases that they could put it up that much, and obviously they generally are, because the average increase for a council tax bill from April is meant to be around about £100. So Andy just quoted 120 there. There you go. So you're probably all going to have an increase in your council tax. So unfortunately, that's not the best thing. Personal allowances, income tax personal allowance is currently £11,500. You're going to have £11,850 from April. And the other allowance that's going up is your capital gains tax allowance will go up from 11,300 to 11,700. So some increases there. I mean, only marginal. You may not realise that there was actually a spring statement, which isn't quite a budget, but it's a bit like the old-fashioned budget, happened this week. That might have passed you by, Andy. It almost passed everybody by because it was so uneventful. So there was nothing really announced in there that was going to cause any great shakes, apart from the fact that people seem to get up in arms over the prospect of 1p and 2p coins disappearing from circulation, which was touted by Philip Hammond. Now, that has since been backtracked. They never said they were going to actually ban them or get rid of them. Don't ban them, but, you take them from circulation. And if you look at the stats, the reason why they were contemplating it, they were going to do some research into the use of various different coins and notes and obviously electronic payments in our banking system currently, because most coppers are only ever used once apparently, and I think 1 in 12 is thrown in the bin, which is quite an amazing statistic. So people get all upset about not having 1p's and 2p's. I remember halfpenny coins and being able to get penny sweets. There'll be people listening to this podcast who will be able to remember even further back. But the point that I just wanted to say to people, it's all right getting all up in arms about coppers, but if you don't use them, then I'm not quite sure if it's just nostalgia, and I'm not really sure their purpose. And the other thing it really gives a quick nod to, I know I've deviated off topic, is that one of the things people say to me or ask me is how to be able to teach people or teach children about money and help them to become financially literate. Now, using money is one of the best ways to do that. Them seeing you use money is one of the best ways to educate children, because if you ask most kids these days, they think you pay for things by getting a bit of plastic out of your wallet and just tap it on a machine. So you need to use coins and notes. And of course, if you're not using coppers, then how are they going to be able to understand the value of money or be able to count coins, etc.? So,
Damien, it's funny you should say that, actually, because that's rather timely, because my daughter gets sort of homework each week, and on a Friday afternoon we get an update from the school telling us what they've been up to for that week and what to look forward to next week. And I'm reading this directly from the homework sheet. We will be looking at giving the correct change in our money topic next week in maths. So any practice at home would be very beneficial to the children. So it seems like the schools are taking heed of that.
Yeah, and I'm not being high and mighty. I'm as bad as the next person. I can't stand coppers. I can probably count on one hand how many times I've paid with coppers, certainly in the last 12 months. And I don't tend to carry cash anyway. I tend to rather just tap things, and because I don't have to have change, etc. So let's try and use coppers more if we want to keep them. Other changes that are happening in April include prescription charges going up 20p. I mentioned that on the podcast 2 weeks ago. The higher rate tax band will go from 45,000 to 46,350. Auto enrolment. Now, most people should know actually what auto enrolment is, but that's where you are automatically put into your company's pension scheme unless you opt out of it. And now at the moment their contribution rates are 1% for employees and 1% for employer. It's a great idea, and it's been working well in trying to encourage people to save for their own retirement, but that's going to go up. So it's 3% for employees and 2% for employers. So that will bring the grand total up to 5%, which it is currently 2%. State pensions are going to go up by around 3%, and the dividend tax allowance is going to be cut from 5,000 to 2,000. We touched upon that last time. So there are a number of changes. Most of them are in relation to allowances. Nothing like too crazy going on, which is a general positive, I think. Now, in terms of to-dos, if you are or you're planning on contributing to an ISA, then you need to do so before the end of the tax year. There's a £20,000 allowance, don't forget. Also, if you're going to invest in the stocks and shares ISA, you don't have to pick the funds before you put the money in. You can put the money in and plonk it in cash within the stocks and shares ISA wrapper, and then pick your funds at a much later date. So don't lose your ISA allowance. Make sure you use it. Obviously, if you want to use cash ISAs, then make sure you use your allowance.
So in a stocks and shares one, what you're saying there, for instance, is so long as you get it in before the deadline, you can just leave it sitting in cash. You don't have to make any decisions. You just get it in there before the deadline.
Yeah, and what happens is eventually your provider will probably write to you and suggest that you actually invest the money, because you're not making any money. And the idea is you're meant to be investing. So they might not, but they used to anyway. So get it in there. Make sure you use your allowance, or else you will lose it. Pensions, if you plan on making pension contributions, again, they're tax year specific, so you will want to do that before the end of the tax year. The end of the tax year, of course, is the 5th of April, and you have to do all this by midnight on the 5th of April. I know you can carry forward unused allowances, but again, it's worth using them now. If you want to make gifts for inheritance tax purposes, so you're trying to mitigate inheritance tax, then those limits, which I'm not going to read out now, you can go on moneytothemasses.com and Google inheritance tax, and I talk about them. They are all relevant to a tax year. And the other thing is, if you want to crystallise any gains you've had on investments or assets, you will want to do that this tax year. Then you can use your capital gains allowance, and then you could subsequently, after at a later date, maybe buy back in. So that's called bed and ISA-ing, or it used to be called bed and breakfasting, but you normally have to wait a period of time. So the main point on that is, if you've got a capital gains tax allowance, you might want to use it. Then if you don't, you will have lost it. So there you go. There's a bunch of things to think about. I might come back in detail nearer the end of the tax year with specifics about what you can and can't do around tax, particularly probably about the capital gains tax stuff, because some people find it quite interesting. So there we go, Andy. That's the tax year stuff. Shall we go on while you're eating malwam? Shall we? And actually, Andy's choking in the background. You haven't heard that, but Andy is. I hope he's not choking on a malwam. Shall we go on now to the banks?
Yeah. Yeah, let's do it.
There you go. You did hear Andy. He's surviving. Now, digital-only banks. Now, I'm not a user of a digital-only bank, and people, if you don't know what they are, there are a whole host of banks that have launched that are specific just to apps. They might be an app-only entity, so there are no high street branches. There may not even be an online dashboard in which you use. It's just done via an app, and they are becoming increasingly popular. And everybody thought they're generally these challenger banks, they call them, because they're challenging the status quo. We're going to be take huge market share. But there was a piece of research which, whether it actually shows a true trend or not, or it was just specific to the sample that they took, showed that people were starting to desert these new brands and going back to the old favoured brands on the high street. I'm not sure that's actually true, because you look at the numbers, they're still getting a bigger and bigger chunk of the banking pie. But I just wanted to run through a few of them. I don't use them, but there are people out there who might wonder what they are and what do they do. So as a quick roundup, I'll go through about 3 or 4 of them and some of the pros and cons. Now, Monzo, Monzo, is one that I've heard quite a lot of positive things about, although I've had no direct experience of. And they are one of these digital banks. They've got over 500,000 customers, and it launched in 2015, which is quite impressive. It has got a full banking license, which means that your money is covered by the Financial Services Compensation Scheme, and that you might think of course it will, but in a second you'll hear there are others that don't. Now, what typically happens with these digital banks, they might have tools or some features that help people in spending. So they might have spending trackers. Now, I'm a fan of spending trackers. Anyone who's read the 30-day money plan, which you can get free if you want to download it on moneytothemasses.com, then one of the things I do say about tracking your spending using a third-party app, well, some of these digital banks have that built in, which I think is quite neat, and I like the idea. They also try to make banking a little bit more transparent, and the charges were a bit more explicit. They even have features that were meant to be things that customers really wanted. So no, if you lose your bank card, then you end up having to get it frozen or cancelled and reissued. They allow you to do temporary freezing on your card via the app, which I think is a great idea. Because when you just think, have I left my wallet at home? We've all done that, haven't we, Andy?
Yeah.
So they have that option on Monzo. One of the things that is quite good is that because it's a brand that they're trying to build something that the customers want, they allow customers to almost vote on new features that might come along. So there's a product out there called, just completely separate, called Trello, which is a sort of management software that I use on Money to the Masses to be able to manage tasks. And I know a lot of big firms use it, but Monzo use it and allow customers to go in there and leave comments and vote on things they'd like to see. So it's very positive in that regard, Monzo. It was a prepaid product, so you'd put money on it. It's now changed to actually a current account, which is a big positive. I think some of the existing customers like the idea of a prepaid account, and they're being forced to move across to this new current account system. But I don't see that as a big issue. Surely that's what you want. You want a current account that works. One of the big selling points was that they allowed you to have free cash withdrawals when you went abroad and free spending. Now that is an attraction, because a lot of banks and building societies charge you ridiculous fees to do it. Now they've had to rein that in because the cost is unsustainable for them providing it free. So now there is a limit. I think it's around £200 every 30 days, which you can take out of a cash machine abroad and not be charged. After that, there's a 3% charge, but you can still spend on your card without any charges. So there are some big positives with Monzo. One of them being it's largely free to spend abroad. There's lots of tools to stop you overspending. It can be used as a main account, like a current account, and there's lots of transparency and new features. Perhaps some of the downsides is they don't pay interest on any savings that you have, so that's a bit of a minus. They've got to recoup costs somewhere, which you'll see that's a recurring theme on lots of these app-only banks. Bizarrely, there's a waiting list. You can't just decide, I want a Monzo card, I want Monzo as my current account. You have to join a waiting list to be part of it, and apparently it's about 2 days to get in there, which is okay. It's not too long, but maybe they're causing demand. Do you remember, what's that clothing store that does that? It used to make people queue outside.
Oh, yeah, they still do it. Yeah, is it...
The surfing-looking one.
Yeah.
I can't remember. See, it shows you, listeners are screaming at their mic and going, I can't believe Damien can't remember the brand. I just remember the people standing outside who were semi-clad. And, if you will see the clothes I wear when I do my podcast, you'll realise that I'm not the most fashionable of characters. But going back to Monzo, there's an overdraft you can turn on and off, but the charges can add up, so it's not perfect. And one of the other downsides, it's not part of the current account switching service at the moment. So if you move things, then you're going to have to make sure, if you're going to move across to it, you're going to have to make sure you look at your own direct debits, etc., that they don't get missed during the transfer. So you're going to have to sort that out. So Monzo, on the whole, the feedback I've had, that it's a great product, it's transparent, it's cheap, and because it's app only, it works really well if you don't want all the other bump that goes with most other banking. Now, moving on to others, there's one called Revolut, which again I've not used, but I know quite well. Now, this is not covered by the Financial Services Compensation Scheme. It doesn't have a banking license, so for me, that would put me off, because it means that if the bank goes bust, your money's not protected. Now, they are very, very popular because it works slightly different to the likes of Monzo, is that they actually have a premium account you can pay for, which is $6.99 a month, which I don't actually think is worth it when you look at the benefits. But what they do is they offer a lot of other additional financial products on top of the banking. So that might be, for example, investments where you get cash back. There is one that they've got with PensionBee at the moment. So if you consolidate your pensions, you get a cashback reward. So it's good in that respect. It's a bit like having an account where you use it, but you get all these additional benefits. But if you're not going to use them, then it's probably not worth it. But where Revolut really made its name is the free withdrawals and spending abroad. So in that regard, if you imagine you wanted an online bank that was going to be great so you could just go on holiday and use your money without being charged, then that's why it became incredibly popular and is very popular. So it's got that over Monzo at the moment. If we move on, there's another one called Starling. And Starling Bank is, again, another current account idea, but it has got a full banking license. Now, if you took the Revolut and Monzo and mashed them together, or they had a love child, it would be Starling Bank. So there you go. That's one. So the positive and negatives are the positives and negatives of the two previous things I just mentioned. So most of the features in Monzo and Revolut are all in one place on here. That's a positive. They have a low overdraft fee, but they do pay interest on your money, which is a positive. Downside is that the interest rates are low. Now, finally, Atom Bank. Now, Atom Bank is maybe fairly well known, but not for a current account, because it doesn't have a current account, but it has savings accounts, and it offers savings rates that often top the Best Buy tables. Now, if you've a regular listener, you may remember I went and met will.i.am once. It was Atom Bank who arranged that, because he is part of their proposition. He's part of I think he's on the board, so he's paid and has interest in the bank doing well anyway. So if you see anything to do with will.i.am and banking, it's Atom Bank. So what they do is they do mortgages very well, and they do savings accounts very well. The mortgages can only be acquired via a broker. That's not necessarily a problem. I think most people should really use a mortgage broker anyway when they're getting a mortgage. And the reason I say that is because there are a whole host of reasons why you might not get a mortgage, despite it being advertised, your own circumstances being the main reason, and your credit history. A broker can see through all that and actually tell you who is the most likely lender to lend to you. So Atom Bank is great for savings. The problem is their savings accounts appear in the Best Buy tables at the top, but they don't last very long. So when you have a Best Buy in a savings account, what they do is they really have like a tranche of money that they can fill up, as it were. So as soon as they get a certain amount of money from in their savings accounts, then they'll stop and they won't do it anymore because they've got enough. And that is obviously a positive, but it's a bit of a slight disappointment, I suppose, for customers. You'll see them pop in and out. So Atom, selling points, good mortgages, good savings accounts, but the downside is that is all it does. So there you go. Quick roundup of the app-only banks. They are still popular. I think they've got a place in banking. I think the Starling Bank is interesting because it's a bit of a mash-up between Monzo and Revolut. I've heard positive things about that, but I've particularly heard it about Monzo, although I've not used it. So if there are customers out there listening to this podcast, do tell me the positives and negatives that you feel about any of these or any other of these app-only banks that you're using, because we can pass them on. Because I think the world of banking needs a shake-up, and there's nothing wrong with using these starter brands or challenger banks. Some people are put off by them, but as long as they're covered by the Financial Services Compensation Scheme, the FSCS, then I don't have too much of an issue with people using them. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insight, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers in the market. So
Everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, and that moves us on to pensions, and in particular pension myths. Damien, you're going to debunk a few things here. What have we got?
Yes, Andy, pension myths. So all I want to do is just throw a few things out there that are maybe just misconceptions about pensions, and it's quite timely because people are thinking about putting money into a pension, perhaps because we're getting towards the end of the tax year. So let's throw one out there. My property is my pension. That's a popular one. Now, it's not a myth, but it's a bit of a misconception, because what tends to happen is that people, when they get to retirement, they don't want to downsize. They will tend to downsize later in retirement if they have to, due to health reasons. So you've got a property that your house and you're living in, you're going to get to retirement and go, I'm going to downsize. Now, I've seen it happen, and I've also seen people who are incredibly unhappy as a result of them downsizing, because they end up having to live in a house that is not the house that they would have lived in or thought they would live in at retirement, and actually is a house that's probably more akin to the house that they bought when they first ever got on the property ladder. So I think the idea, people listen to the podcast, they know that I'm not a fan of your house being your pension, each to their own. But I think that if you look at the average return on a property, it's about 3% a year. It's just about above inflation if you go back till like the 1960s. But of course that masks some big peaks and troughs. When it comes to investing, then with shares, you're likely to get 5% above inflation on average. Now that covers some huge ups and downs. So I'm not saying that you're going to have a fantastic time. There'll be people who do invest and then they get to retirement and they didn't reduce their risk, and they may have a smaller pot than they wished. But I think the idea that people want to take away is that with property, it's one asset, one egg in one basket. Whereas with investing, you can invest in commercial property, all sorts of assets, and spread risk and reduce risk as you get towards retirement. You can't do that with your house. You can't reduce the risk that your house poses or a correction. Let's just be honest, at the moment in London, house prices have fallen for the most they have in a number of years. It's not like disaster, but there's a trend to say that the most expensive areas are starting to dip in price. So, and you can't control that. Next myth, you don't earn enough to pay into a pension. That's nonsense. Auto-enrolment that we mentioned earlier just shows that they're targeting around 5% of your earnings to put into a pension. I know that's partly made up of employer contributions. Something is better than nothing. And if you don't believe me, then go on to moneytothemasses.com. A while ago, we did a piece that showed how you could get a £25,000 a year pension by contributing just £80 a month into a pension. Now, go and read it and I'll explain it. There is actually a podcast based off of that article, which we did probably 2 years ago. So if you scroll back through, you'll find it. It's got a name similar to what I just said. So you can get a decent pension without having to break the bank. Another myth is that the only way to boost your pension is to pay more in. That's not true either. That article highlights a number of ways you can boost your pension. That's how that article works, basically. It shows you ways to boost your pension without paying more in. I'll give you two of them. Reduce your charges and increase your investment risk. If you're saving for retirement and you've got 30, 40 years to go, you can take a hell of a lot of investment risk, because the market's going to rally and crash a number of times. There's going to be a number of economic cycles, and you've got plenty of time to recoup some of those losses. One of the other myths is that once you start paying to a pension, it's a one-way street. So you start, that's it, you can't stop. That's nonsense. You can start and stop whenever you want. And so it's got a great amount of flexibility. Another one is that once your money's in your pension, that's it, you can't get at it. Well, that used to be the case. You can't get at your pension pot until after 55, but currently, it may change, but currently you can cash in your pension. Another one is that people still believe you have to buy an annuity when you get to retirement. You don't. You can cash in your pension effectively. There are tax implications, but you can also withdraw an income separately, and you don't have to take all your pension at once or access all your pension at once. I suppose the other one is that the state will look after you. That again is a nonsense. If you look at a general trend, the age at which the state pension is being paid is increasing. Now, since we've been doing this podcast, Andy, yours and my state retirement ages, which we would get a state pension, I think it's gone up by 2 or 3 years.
What, just in the last 40 minutes?
Not No, I tell you what, it probably has. But in the last few years, it has increased. And that trend is going to go up. And that's because we're living longer. And it's all down to this idea that the way the state pension system works is national insurance contributions are paid in. There's no pot for you. It goes in to a big pot and immediately today's pensioners draw out. It's like a cash machine. You're putting the money in one side and the pensioners on the other side taking it out. And all that happens is when you get to retirement, you go around the other side of the cash point and join the queue pulling the money out. Problem is there won't be enough people putting enough money in because our population is getting older and there are going to be more and more retired people than workers unless we increase taxes or we reduce the amount that people can take out the cash machine, i.e. reduce the state pension relatively. So that is likely to happen. So the state will not provide for you into retirement. Of course, there's a certain element that it will do if you've got no money at all. But I think I'll bank on the fact if you're young that you're probably not going to have a state pension. And one of the others before we finish up is that if you are a higher rate taxpayer, you automatically get your tax relief on any contributions. You don't. What happens, you automatically get the 20% basic rate tax added to your pension. That goes in there. The government does that for you. But if you want to get the additional, so if you're a 40% taxpayer, you want to get that extra 20%, you've got to claim it back via your self-assessment. So no one's going to do that bit for you. It'd be great if the system was simpler, but it's not. That's just the way it works. So there you go, Andy. A bunch of pension myths that people still believe. One other I'm going to finish on actually is that it's not a pension myth as such, it's a retirement myth. And the retirement myth is that the way you save for retirement or plan your retirement, you have to use a pension. Now that is nonsense. I'm a real believer in flexibility. You don't have to use a pension. There are other ways. I think there are people who side hustles, building businesses, having hobbies that make money. There are investments that aren't pensions that you can have access to, like ISAs and things that you can use to pay an income in your retirement. So multiple ways, and I think if you just use a conventional method of saving for your retirement, you're probably going to have a fairly conventional retirement itself. So pensions are great because they're tax incentivized and in a way designed help you retire, and they're probably the most attractive way now given the amount of freedoms and access you can have after 55 to save for your pension, but they're not the only way to do it, so don't be misguided. There you go, Andy, I think I'm done.
Good. If you want to get in touch with Damien, as always, you can. It's at Money to the Masses, that's with the number 2 on Twitter, and if you want to get in touch via email, it's Damien at moneytothemasses.com. Review the podcast if you can. It really helps us get up that iTunes chart, and you may well get your review read out on next week's show. Damien, anything else?
That's it, Andy. And if you've got any ideas or topics you want covered on the podcast, then do tweet, do email and suggest them, because I will try my hardest to cover them.
Good. Until next week.
Until next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.